You have spent decades building your nest egg, sacrificing today to secure your tomorrow. But if you carry the wrong assets across the retirement finish line, the IRS is waiting to confiscate a massive portion of everything you have worked for. The tax code actively punishes retirees who hold on to certain types of investments. And there is one specific account you probably think is entirely safe right now that could actually become a ticking tax bomb the moment you stop working. Today, we are going to walk through the exact 5 assets you need to sell before you retire, because missing even one of these could mean the difference between living out a comfortable, stress-free retirement and constantly looking over your shoulder, worrying about running out of money. I have seen far too many hardworking people step into retirement thinking they are financially secure, only to get blindsided by unexpected tax bills, hidden Medicare premium surcharges, and forced withdrawals that ruthlessly drain their accounts. I want to protect you from making those same heartbreaking mistakes. Over the next few minutes, we are going to break down these 5 dangerous assets, starting with one of the most common traps hiding in everyday portfolios and leading up to a massive, counterintuitive trap that catches almost everyone completely off guard. I will explain exactly why the IRS targets them, how the financial math actually works behind the scenes, and precisely how you can safely exit these positions before it is too late to protect your wealth. Let us start with an asset that is deeply tied to your identity and your career, which is highly appreciated, over-concentrated company stock. For many of you, working for the same company for 10, 20, or 30 years has been a point of immense pride. Over those decades, you may have been compensated with stock options, restricted stock units, or you simply bought into the company's employee stock purchase plan because you believed in the mission. You watch that stock grow. It feels safe. It feels familiar. But heading into retirement with a massive portion of your net worth tied up in a single company is one of the most dangerous financial risks you can take. And the tax implications of trying to unwind it after you retire can be devastating. When you hold on to a single stock that has grown significantly in a taxable brokerage account, you are sitting on a mountain of unrealized capital gains. If you wait until you are fully retired to start selling off this stock to pay for your living expenses, you lose control over your tax brackets. Imagine a scenario where the stock market takes a dip, or worse, your specific company faces a crisis and the stock price plummets. If you are forced to sell shares just to pay for your groceries, property taxes, or medical bills, you might be forced to sell during a major downturn. Even worse, if the stock is performing well and you need to pull out a large lump sum for a major retirement expense, like a medical emergency or a home repair, selling a massive chunk of that highly appreciated stock all at once will trigger a massive capital gains tax bill. It could instantly push your adjusted gross income into a much higher tier. This doesn't just mean paying more in capital gains tax. It means you could trigger the net investment income tax, which adds an additional layer of taxation on top of your standard rate. Instead of waiting until you are entirely dependent on your portfolio to survive, you need to systematically sell down this over-concentrated stock in the years leading up to your retirement. While you are still working, you can strategically pair the sale of this stock with any investment losses you might have in other parts of your portfolio. This strategy, known as tax loss harvesting, allows you to neutralize the gains of your company's stock by selling off losing investments, effectively allowing you to diversify your portfolio without handing a massive check to the IRS. By selling this off before you retire, you convert a risky, single point of failure asset into a broadly diversified, tax-efficient portfolio that will actually protect you when you no longer have a steady paycheck coming in. Do not let your loyalty to your employer blind you to the reality that the IRS is just waiting for you to make a panicked withdrawal. The second asset you absolutely need to part ways with before you enter retirement is expensive, non-income producing real estate. I am talking about that oversized primary residence, the vacation home you rarely visit anymore, or that plot of raw land you bought years ago thinking you would build on it someday. Real estate is often touted as the ultimate wealth builder, and over your working years it probably was, but in retirement the rules change entirely. Real estate that does not generate regular rental income is not an asset in retirement. It is a massive liability masquerading as wealth. And the tax trap here is twofold: property taxes and the capital gains exclusion limits. Consider your primary residence. You might have bought a large family home decades ago for a fraction of what it is worth today. You raised your children there, and the emotional attachment is profound. But holding on to a home that is too large for your current needs means you are bleeding cash through property taxes, exorbitant utility bills, and constant maintenance. The IRS offers an incredible gift to homeowners through Section 121 of the tax code, which allows a married couple filing jointly to exclude up to $500,000 of capital gains on the sale of a primary residence or $250,000 for a single filer. But here is the trap. If your home is appreciated by $600,000 or $700,000, or even $1 million since you bought it, you have a massive looming tax problem. If you wait until you are deep into retirement to downsize, perhaps because your health declines and you are forced to move into an assisted living facility or a single-story home, you will be hit with capital gains taxes on every single dollar of appreciation above that exclusion limit. Selling the house before you retire, or right on the cusp of retirement, allows you to lock in that tax-free $500,000 gain and reinvest those proceeds into income-producing assets that will actually pay you to live. Furthermore, if you lose your spouse before you sell the house, you eventually lose that joint $500,000 exclusion. A surviving spouse who is forced to sell an oversized, highly appreciated home later in life will suddenly find their tax exclusion slashed in half, resulting in a devastating tax bill at a time when they are already grieving and financially vulnerable. Sell the massive house, sell the empty lot, and sell the unused vacation home while you still have the energy to manage the transaction and the tax strategy to shelter the profits. The third category of things you need to sell might sound completely backwards to those who view themselves as collectors or alternative investors, but it is critical. You need to liquidate high-value collectibles and physical precious metals. I am talking about physical gold and silver coins, classic cars, rare stamps, high-end art, and expensive antiques. Over the last few years, a tremendous number of people have poured their savings into these physical assets, terrified of inflation and convinced that having something they can hold in their hands is safer than leaving money in the bank. While these items might hold their value, trying to rely on them to fund your retirement is an absolute nightmare, primarily because the IRS despises collectibles. You might assume that when you sell a gold coin or a classic car that has gone up in value, you will pay the standard long-term capital gains tax rate, which maxes out at 20% for the highest earners and is often 0 or 15% for the average retiree. That is a dangerous misconception. The IRS has a special punitive tax category specifically for collectibles. When you sell these items, the gains are taxed at a maximum rate of 28%. That is a massive difference. Imagine needing to sell a piece of art or a collection of silver bars just to cover a gap in your living expenses. Not only do you have to find a buyer, deal with dealer commissions, and handle the logistics of selling physical items securely, but the IRS is going to take up to nearly a third of your profit. Even worse, collectibles produce absolutely zero income while you hold them. A stock pays dividends, a bond pays interest, a rental property pays rent. A gold bar sitting in a safe simply sits there, costing you money in insurance and security. In retirement, cash flow is the oxygen that keeps your financial life alive. If you have $50,000 or $100,000 tied up in a coin collection or a vintage car, that is money that is completely suffocated. Sell these items before you retire. Take the hit on the 28% tax rate while you are still working and can absorb it with your regular income, and move that capital into tax-efficient, income-producing investments that will actually pay your bills without triggering a specialized IRS penalty rate when you need the cash the most. We still have 2 critical assets to cover, and I need you to pay very close attention to the final one on this list. It involves a specific type of account that almost every financial advisor tells you is the absolute cornerstone of your retirement. But I promise you, if you do not restructure this specific account before you stop working, it is going to trigger the largest, most painful tax bill of your entire life. But before we get to that massive trap, let us talk about the silent killer hiding in plain sight in your standard brokerage accounts. The 4th thing you must sell before retirement is any actively managed mutual fund sitting in a taxable brokerage account. When you were younger, you likely bought mutual funds because they offered an easy way to diversify. You handed your money over to a fund manager and they did all the buying and selling for you. It felt responsible. But inside a taxable account, actively managed mutual funds are a ticking tax liability because of something called phantom capital gains distributions. Here is exactly how this happens. A mutual fund is a pool of money from thousands of investors. When the fund manager decides to sell a stock within that pool at a profit, that capital gain does not just stay inside the fund. By law, the mutual fund must pass those capital gains down to you, the individual shareholder, at the end of the year. This means you could hold a mutual fund for an entire year, never sell a single share, actually lose value if the market goes down, and still receive a massive tax bill in December because the fund manager was aggressively trading behind the scenes. When you are working, you might be able to handle these surprise tax bills by paying them out of your salary. But in retirement, phantom capital gains can destroy your financial plan. Imagine you have carefully budgeted your retirement income to keep your taxes low. Suddenly, in December, your mutual funds distribute tens of thousands of dollars in capital gains. This phantom income is added to your adjusted gross income for the year. It can push your Social Security benefits into a higher taxable bracket. Most dangerously, it can trigger IRMAA, the Income-Related Monthly Adjustment Amount. This is a hidden penalty where the government looks at your tax return from 2 years prior, sees that spike in phantom income, and massively increases your Medicare Part B and Part D premiums. You are literally paying more for healthcare because a mutual fund manager decided to trade stocks without asking you. Before you retire, you must systematically sell off these actively managed high turnover mutual funds in your taxable accounts. Yes, you might have to pay some capital gains tax to get out of them, but it is a one-time pain to cure a chronic disease. Replace them with highly tax-efficient exchange-traded funds, or ETFs. Due to their unique structure, ETFs rarely pass on these phantom capital gains. By cleaning up your taxable account before you retire, you take back complete control over your tax bracket. You decide when to sell, you decide when to realize a gain, and you completely shut the IRS out of your portfolio until you are good and ready. Now we have arrived at the 5th and final asset you need to sell. This is the most important point of all, and it is entirely counterintuitive. You have been told your entire life to save money into pre-tax accounts. You have dutifully poured portions of every paycheck into your traditional 401k, your 403b, or your traditional IRA. You got a tax deduction every year you contributed, and you watched that money grow tax-deferred for decades. You look at your account balance, and you feel proud. But I need you to understand a very harsh reality. You do not own all of the money in that account. The IRS owns a massive floating percentage of it, and they are waiting to collect. The asset you need to quote-unquote sell out of is your deeply bloated, traditional pre-tax retirement account. Now, you are not selling the investments to cash and hiding it under your mattress. What you must do is sell out of the pre-tax tax status by executing strategic Roth conversions before you get deep into retirement. Here is why this is a life or death financial maneuver. When you put money into a traditional IRA or a 401k, you made a deal with the government. They agreed not to tax you then under the strict condition that they get to tax you later when you take the money out. Every single dollar you withdraw from a traditional retirement account is taxed as ordinary income, not capital gains rates, but your highest marginal income tax rate. And the government is not going to let you defer those taxes forever. Once you reach your early 70s, the IRS enforces required minimum distributions, or RMDs. They legally force you to pull a specific percentage of money out of your pre-tax accounts every single year, whether you need the money to live on or not. If you have done a great job saving and investing, your traditional IRA might be worth $1, $2, or even $3 million by the time you retire. When those RMDs kick in, you could be forced to withdraw $80,000, $100,000, or $150,000 a year of pure taxable income. This forced income piles on top of your Social Security, on top of any pension, and on top of your other investments. It will permanently lock you into the highest possible tax brackets for the rest of your life. And it gets much worse. If you are married and you pass away, your surviving spouse now has to file as a single taxpayer. The tax brackets for single filers are significantly compressed compared to married couples. Your spouse will be forced to take those exact same massive RMDs, but now they will be pushed into an even higher, more punishing tax bracket, potentially losing up to 40% of those withdrawals to federal and state taxes. Your lifetime of hard work will be aggressively drained away to fund the government. This is why you must sell out of this pre-tax trap before the RMDs begin. You do this through a series of partial Roth conversions in the gap years. The gap years are that golden window of time between when you retire and stop earning a high salary and when you are forced to start taking Social Security and RMDs. During these years, your taxable income naturally drops. You take advantage of this low tax window by moving specific amounts of money from your traditional IRA into a Roth IRA. You will pay the ordinary income tax on the amount you convert today, but you are intentionally choosing to pay it at the low tax rates that currently exist, rather than the much higher tax rates you will face later. Once that money is in the Roth IRA, the game completely changes. The money grows completely tax-free forever. More importantly, when you pull money out of a Roth IRA in retirement, it does not count as taxable income. It does not push you into higher tax brackets. It does not cause your Social Security to be taxed. It does not trigger Medicare IRMAA penalties. And Roth IRAs do not have required minimum distributions during your lifetime. You are permanently evicting the IRS from your retirement savings. It is the single most powerful financial move you can make, but the window to do it efficiently closes the moment those mandatory withdrawals begin. You must strategically sell out of your pre-tax position while you still have the power to control the tax rate. Let us briefly recap the absolute necessities we have covered today. You cannot afford to carry over-concentrated company stock into retirement and risk a market downturn wiping you out or triggering massive capital gains when you need cash the most. You must unload expensive, non-income producing real estate to lock in your $500,000 tax exclusion and stop bleeding cash to property taxes and upkeep. You have to liquidate physical collectibles like gold, silver, and classic cars to avoid the devastating 28% penalty tax rate and convert those dead assets into cash-flowing investments. You need to purge actively managed mutual funds from your taxable brokerage accounts so you are never again surprised by phantom capital gains distributions that secretly ruin your tax planning. And most importantly, you must systematically sell out of your massive pre-tax retirement accounts by completing strategic Roth conversions before the IRS forces you into devastating required minimum distributions. I know confronting these assets can feel overwhelming, especially when you have spent your whole life being told to buy and hold. But protecting your wealth is just as important as building it, and taking action now is the ultimate act of care for yourself and your family's future. You have worked far too hard to leave your financial security up to chance or the changing whims of the tax code. I want to know which of these 5 assets surprised you the most, or which one is currently keeping you up at night. Go down to the comments right now and share your experience with your portfolio, or tell me which of these assets you are going to start unwinding first. Your story might be the exact wake-up call someone else in this community needs to read today.